Wall Street pauses for a breather after 4 days of blistering gains, but the euro is at a critical inflection point. And over the next 24 hours, it's probably going to have to decide, is the uptrend going to sustain, or are we going to come crumbling down? Welcome. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And we are focused on the euro today because we are going to get some big event risk coming up over the next day here from both the euro area and the US. Time when the exchange rate here rests at a critical trend defining juncture. That, of course, sets us up for what could be a trigger to trade this thing one way or the other. So what we're going to do here is look at what the key levels are and what this event risk might do to get us through either the top side or the downside and set up a tradable opportunity for next steps. So first, let's get a little bit of stage setting. Here's the euro. This is the 6E futures contract. And what we see here is that basically since the beginning of October, it has been marching higher against the US dollar. And then, of course, with the recent cooling in Fed rate cut expectations, it has come under some pressure from the beginning of this year. So this right here are the last 2 days of 2023. This is the first day of 2024. And so we can see here a clear sort of a pullback in what has been a multi-month advance that has landed us squarely on where that advance finds its bounds. Now, support and resistance are almost never just a single line. And so what we're looking at is essentially from this low to this low and then out to perhaps as low as this to give us a sort of range of where the bounds of the trend are. And as you can see, we're resting right on that currently. And so this is really the key decision that the euro has to make. Either it will break through here, taking out the bounds of this correction lower, this series of lower highs and lower lows, and establish a perch somewhere here, suggesting we're in for the next move higher, similar to how we got a pullback here, a bit of digestion, a bit of a test, then the next leg. We might be looking at that version of events here, or, since of course we're right on the dividing line between what is the trend higher and its reversal, we might come in and end up down here, suggesting the up move is over and a new trend lower is beginning. So we are very much at decision time here. Now, the first part of this equation that is going to get handed to investors is going to be a monetary policy announcement from the European Central Bank. The expectations are that we're going to hold things steady here. We can see the first rate cut is on the menu somewhere by June. So as we look here, we can see at June, one rate cut is already baked in. That's in that hikes cuts column right here. So we can see over here, one full cut is in the outlook already with an 83% chance for a further cut by this time. Now, for April, there's a 68% chance that the first cut actually occurs earlier at this time. For that meeting, we can see narrowly over 50% chance that it occurs here. And of course, slight 2% chance for a cut this week, which basically says it's not going to happen almost certainly. A little bit more in March, 14%, and then the 52 here come to cumulatively 68% by this meeting. And then by June, this cut is there. The first one is there, and the possibility of a second one by then is 83%. So we're looking at a situation here where at bare minimum, one cut is coming by June, and the markets are tilting towards two. Now, with that, we also have the start of a rate cutting cycle that is expected to bring rates down by the end of the year to the tune of something between 1.25% and 1.5%. Since we're moving in 25 basis point increments here, what that's telling us is we're going to get at least 125 basis points in easing. That means 5 cuts. And then there is a 27% chance that we're going to get a 6th one. See that right here. 5 cuts and a 27% chance for a 6th. So that's the baseline. That's what we're working with here. And indeed, we can see that expectations for ECB monetary policy have been shifting in a more dovish direction. So if we look at where the curve was when the ECB met in October for the implied policy path, there has been a very meaningful shift in that curve, making for a flatter path, looking out between October and the subsequent meeting in the middle of December. So this curve has significantly shifted, in particular past the 3-month mark, where more easing is expected and rates are expected to end up lower on the whole. Now, what's interesting is that between the December meeting and today, this hasn't really changed, despite the fact that the euro has moved, obviously, in that time. And also, the ECB has been loudly trying to talk down rate cut expectations, saying they're not going to move as fast as the markets are anticipating. Markets, however, don't seem to really care. They think that cuts are coming, and as we can see, the current curve in the solid line is barely changed from December's outlook. And that's not really something that ought to be surprising, because all of the ingredients for a rate cut campaign seem to be there. Needless to say, the first focal point here is inflation. What we can see is that it's helpfully down to just 2.9% from a peak of over 10%. So what the ECB wants to have happen is indeed occurring. Now, what we also see is that those things uplifting inflation here are at once going in the ECB's favor and probably not amenable to further tightening. So just eyeballing this, we can see that the purple area toward the bottom that tracks food is still the biggest contributor to inflation. And in fact, if we look at how this breaks down, we can see that of the 2.9% inflation that we got in December, nearly a full percentage point owed to food. So if we were to take food out of the equation here, we would be looking at an inflation rate closer to 1.9%. So essentially right on the ECB target. Now, we can see that there's been a little bit of a twitch higher here from 2.4 to 2.9, and that's largely for rebasing and statistical adjustment reasons. When the war in Ukraine initially occurred, when Russia first invaded, the Europeans thought that there would be a significant disruption in fuel supplies, and so they introduced subsidies. Those subsidies are now being rebased out of year-on-year calculations. And so we can see here that energy costs here are starting to become less of a drag on the overall And so while there's still negative, while there's still a negative contribution to inflation, it's less so of a contribution. And so we see this slight uptick here as this rebases. But if we look at the overall picture here, we're still looking at a situation that seems to lend itself toward easing because, of course, that's just a statistical anomaly. It's not as though we have soaring fuel costs as a baseline condition, and they wouldn't be if only for this adjustment. No, crude oil is down, natural gas is down. All of these things have been moving lower for months. So it's not as though there is a meaningful story about returning fuel inflation. Despite the fact, by the way, that we have these disruptions in shipping through the Red Sea, which of course connects the Gulf with the Mediterranean via the Suez Canal, and so would be something that would show up in European inflation in so much as a lot of the energy shipping through the Suez is, of course, first and foremost going to service Europe. So on the whole, what we have is a situation where food is the outsized contributor, but in so much as the ECB can't do very much about that because they can't exactly raise rates enough to discourage people from eating, and they don't exactly have direct influence on global food costs, that part of the story seems to be going their way anyway. And that's because global food prices seem to have peaked out already. Now, what we have here is the overall story. The UN World Food Cost Index is in the orange here, and global inflation is seeming to track that with about a 7-month lag. So it takes about 7 months, it looks like, for what happens in global food markets to filter into CPI. We can see here that, of course, gives us a runway of further cooling in food inflation going forward. So this adjustment in food prices that we've already been seeing, that looks likely to continue. And in so much as this, of course, deflates the biggest part of the inflation story, that's likely to go the ECB's way from here and for at least some months yet. Then we have the growth story. We just got an updated set of numbers on January PMIs, and of course these, as ever, operate on a familiar logic where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. What we see here is that there seems to have been a little bit of an improvement in the Eurozone economy, in particular because manufacturing is shrinking at a slower rate than it was before. However, the story on services, which is a much bigger part of the overall whole, still looks relatively anemic. Services aren't really going anywhere and haven't really gone anywhere basically for a half a year. Now, because manufacturing is starting to essentially shrink less aggressively, the overall index has notched up a little bit in January. Nevertheless, all of this is still in contraction mode. So economic activity in the Eurozone still shrinking, just not quite as fast. And so the economy is screaming for support. Now, the ECB, of course, has opted to be careful. They haven't wanted to commit to rate cuts because they don't want for easing expectations to run away. Those easing expectations, as we just saw, are holding up anyway, even as we get various officials, of course, including President Christine Lagarde, loudly protesting against rate cuts that arrive with any kind of hurry. So the markets are already trying to call the ECB and say, no, no, you will be cutting, and it will be soon. And so really the key question now is, what's Miss Lagarde going to say this go-round? We're getting closer to when the cuts would start to happen. So it would be, for most central banks, enough of a lead to start to set the foundation, to start to leak this information out there slowly to establish a baseline for the markets. Now, of course, we're not getting a cut today, almost certainly, as we just saw. And so the message will probably be still relatively hawkish. But if it looks like the ECB is beginning to lay the foundation for what it's going to do in April or maybe June, the level and the volume of the pushback might start to get watered down. And of course, that's exactly what the markets are out here hoping for. Indeed, they're actively attempting to call the ECB on its higher for longer bias and say, no, no, you have to go. So if they perceive enough of a dispensation here, if they perceive that the ECB is getting closer in how Ms. Lagarde conducts the press conference after the policy announcement, then the euro is likely to suffer. And the path of least resistance will start looking like a break down this way. Alternatively, of course, if she instead continues to push back loudly and the likelihood of a cut in April comes down from where it is now to 67%, cumulative 52% for the meeting, if that comes in, well, then the euro is likely to power the other way. But the ECB is not the only story here, because, of course, it is an exchange rate. It relates to currencies. And here, the U.S. comes into the picture with a first look at fourth quarter GDP data. On this score, the expectation is that we're going to get a climb down from the third quarter's blistering 4.9% growth down to 2%. Now, this is widely expected. So this is not something that ought to be a shock. In fact, when those heady third quarter GDP numbers came out, expectations for further growth and sort of growth-linked assets actually stumbled a bit, as if to say, okay, we've seen the peak. It's going to be slower going from here. So the expectation here for a downturn. Now, will that downturn be market moving? Well, if it's worse than expected, maybe. But of course, as ever, the lens here is what this means for Fed policy odds. And the story seems to be, if we get down to 2%, those policy odds ought not change in any kind of a meaningful way. That would basically be baseline. But scope for a surprise seems greater after what we saw today on US PMI data. It showed a blisteringly better set of outcomes than markets anticipated. When we looked at this at the beginning of the week, the markets were calling for a composite measure at 50.3, down from 50.9. In other words, they were looking for growth to come together to give a 4-month low in the pace of economic expansion. Well, as it turns out, markets were completely offsides on those forecasts because the reality of the situation was much more emphatic. Instead, we ended up with the strongest pace of expansion since June of last year. And so the picture seems to be much rosier than investors anticipated. As a matter of fact, coupled with that outcome, we have a shift higher in the city economic surprise index and a telltale push through the 20-day moving average for that index, you can see that there's clearly a possibility here now for something more akin to this. When this thing tends to break, you oftentimes see a larger push, giving us the sense that perhaps there is now a sense that expectations for U.S. growth are weaker than reality is calling for. That, of course, increases the possibility for a surprise higher on this GDP data. If that's the way that this goes, well, the natural inclination might be that we would get a shift in Fed rate hike or a rate cut, expectations to have still fewer cuts. If we look at what's been happening here at the moment, we find that, of course, those cuts have been already fading from the outlook. So here, just about 2 weeks ago or so, we're looking at a call for 6 cuts. This is about 156 basis points in easing right here. So at least 6 in 25 basis point increments. What we see now over the past 2 weeks is that this has significantly hemmed in, and now we're looking at just about 125 basis points in cuts. In other words, we've gone from 6 cuts to 5. Now, it was really interesting last week when this deepening amount of cuts nevertheless allowed stocks to rally. Whereas we can very clearly see that as cuts were building, stocks were rallying. As cuts ran out of steam, so did stocks. This right here seems to be a change of pace. And then, of course, there was today, where in the wake of these PMI numbers and a bond auction where yields came up, potentially in response, though, of course, we couldn't poll everybody ever, so there's no telling with absolute certainty. But it does seem to generally line up that after you get that very strong PMI data, the bond auction then gives us higher yields for 5-year notes, and the S&P pointedly stalls. So we could be looking at a situation where the markets are struggling to nail that perfect middle path for the economy, where the economy is hot enough that there's not a recession, but cool enough that rate cuts still are on the menu. If we get a hot GDP number, though, fewer of those rate cuts are likely to make sense. If that further suggests that the U.S. economy is hot enough that we need to rethink the scope of easing more concretely, today's price action would suggest, well, maybe the markets aren't happy at good data, aren't happy to rally on that kind of thing if it's too good. If it really starts to eat into rate cuts and brings us down to 4 or 3 from the current 5. That, of course, might weigh on stocks. So not only would we get a situation here, perhaps, where fewer cuts on a yield-based logic offers a lift to the U.S. dollar, but if on top of that there is liquidation in stocks, that, of course, tends to benefit the dollar as well as a uniquely liquid currency. So when the markets are looking to cash out, it's the dollar that's the preferred form of cash oftentimes. And if that's how this goes, well, then the rise in the U.S. dollar might, of course, echo in its most liquid pairing against the euro. So if we take this into the price chart again, if you get an ECB that feels like it needs to push back still, that will be positive for the euro. If you then get a GDP number that's strong, that would be negative for the euro. And so the question is, where do we end up? However the market synthesizes these pieces of information, though, we stand right at the cusp of a break, one way or another. And so the markets might well be locked and loaded to jump feet first into whatever occurs. Because as you get resolution, surely there is a degree of sucking in follow through as markets wait for some sort of decision time. So one way or another, we are here just on the precipice of a trading opportunity. The question, of course, is which way? And the next 24 hours might well answer that question. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, talking about what happened on Wall Street on a given day and what that means going forward. I'm also on with Chris for Futures Power Hour on Friday, on with Tom and Tony for First Call on Sundays, writing for the news and insights portion of tastylive.com. As a matter of fact, an abridged version of this very analysis is already posted there as we speak. And also opining sporadically on the platform formerly known as Twitter, @IlyasPback. Thanks very much for joining. See you tomorrow.